I felt this was something important to touch on because I'm noticing over the last couple of years that I'm arranging several reverse mortgages. I don't know if that's the demographics of my practice or the demographics of me, my hair getting grayer, whatever the case may be. Reverse mortgages are becoming a lot more prevalent in the landscape these days. Perhaps you've heard of them anecdotally or you've seen the TV commercials, but one thing I've come to realize is whether just at first impression or when we unpack the process of qualifying for a reverse mortgage for people that are age 55 and over, there's a lot of misconceptions out there. And the purpose of tonight is, you may be 55 and over and you may be in a position right now for a reverse mortgage, and that's great. Happy to help. Or more importantly, you may know someone who's 55 or over. You may have a family member or a friend who may have considered this, and even more so, you may actually be in an advisory capacity where whether you're a real estate agent or a financial planner or an accountant, and you're advising people that are in this demographic, the 55 plus Canadian homeowner. And a lot of people are sort of dismissing reverse mortgages as a really viable option. What we're here to do tonight, as I said, is dispel a lot of those rumors and show it for what it is, which is not sort of a last resort, a scam or what have you, but a really viable financial tool for integrating into your overall financial picture as you advance through that stage of your life. So without further ado, I'm going to pass the torch over to someone I've been working with for several years now. She is a business development manager for Home Equity Bank. And you may not know that name, but perhaps the more familiar brand is CHIP, the CHIP Reverse Mortgage. Home Equity Bank is the provider of the CHIP Reverse Mortgage. Jen is going to give the presentation tonight. So without further ado, I'm going to pass the torch over to Jen. Jen, please go ahead.
Thanks so much, Toma, and thanks everyone for joining us tonight. Yeah, as Toma mentioned, I am a business development manager for Home Equity Bank. I live and work in Vancouver, and I spend my days primarily educating clients, families, our financial planner partners that work with mortgage brokers, just educating them on the chip reverse mortgage and really how it's being used in Vancouver. So what we'll do tonight is go through sort of what a reverse mortgage is, some myths that you might have heard. We'll address those, and then I have a number of examples for you, just so you can really see how other people in our community are using the chip reverse mortgage.
I'm going to interject just for a second, just to add some
Yeah.
structure to the evening, Jen. So Jen's going to give her presentation. If any of you have any questions while we're making our way through, please make use of the Q&A section. Enter your questions there. I'm gonna leave them, let them accumulate, and we'll wait till the end of Jen's presentation. Then I will field the questions and answers in concert with Jen at that time. Go ahead, Jen. Thanks.
Thanks, Tom. So really what a reverse mortgage is a way to access the equity in your home without any payments. And so, when you think of a traditional mortgage where you're making payments, where, every month a portion of that payment goes towards the principal and the interest. With a reverse mortgage, the interest accumulates, and so you're not making payments, and over time, the mortgage grows rather than shrinks. The with when you have a reverse mortgage, you never need to sell your home. So I guess the biggest difference in how we register a reverse mortgage is that it's registered as a lifetime mortgage. That does not mean that you need to keep it for your lifetime, but it means you can keep it for your lifetime. So you don't ever have to worry about sort of running out of equity or losing the home that you love. You can access up to 55% loan to value. And you'll see throughout the presentation that when I do give client examples, I've given the age of our clients. And that's because the amount that you qualify for with a reverse mortgage depends heavily on your age. So you do need to be at least 55 years old. And then there's no maximum age. You can be 85, 90, 95. And there is no requalification. So once the mortgage is set up, you don't ever need to worry about, coming back to us with income or worrying about whether or not we're going to renew your mortgage. That doesn't happen. As with all mortgage proceeds in Canada, Our proceeds are tax free, and that's going to become really important as we get into our examples later, because for our higher net worth clients, it really becomes a way to access the equity in your home without paying tax or with sort of making a decision about how you're going to use your investments versus the equity in your home as a tax strategy. So we'll get into that in a bit. Just really quickly, why should a reverse mortgage deserve some thought? Your home, for many of us, makes up the largest portion of our net worth. But when you consider your financial plan or what things look like when you retire, very often you only consider the investments that you've saved. But it really is a mistake to ignore that sort of the large portion of your net worth that is your home. So many of us here, if you've owned your home for a long time, you've really benefited from what's happened with the housing market in Vancouver over the last 20 years. And so you have certainly a lot of equity in your home, and this is just a great way to incorporate that into your overall financial plan. We'll talk about the tax implications of using your investments. So even if you have a large, sort of a really great portfolio, there are um, you are going to get taxed as you use that money. And so really what it looks like if you are sort of in that higher net worth, um, if you are higher net worth, that you're going to balance your mortgage proceeds with how quickly you're drawing down those investments. For many of us, we've been taught that you work for so many years and the goal is to pay off your mortgage. And so that is a bit of pushback that we get is that people have worked so hard to pay off their mortgage and perhaps their home is now clear title. It doesn't necessarily have to be if you're going to use a chip, but I do want to challenge whether it's important in retirement that you have no mortgage or whether you actually consider changing that goal to not having a mortgage payment. Unlike your investments, you can use the equity in your home and the value of your home continues to grow. As you draw down your investments, they lose the ability to appreciate and grow in value. And so again, it's really, we talk a lot about balancing how quickly you're going to draw down those investments with how much you access the equity in your home. With a chip reverse mortgage, you do have the flexibility to make payments. Most people take a chip reverse mortgage because of the no payment feature. But if you want to make payments, you are certainly more than welcome to make interest payments. The other thing that doesn't get talked about a ton is the importance of right of survivorship. And what that means is if you and your spouse are both on the mortgage and one of you passes away, the mortgage has right of survivorship, so it continues on just in the one person's name. That is not a feature of a traditional mortgage. And so as you or your parents are getting older, and that is certainly a consideration, it is something to think about. So. I'm sure you have all thought some of these. The biggest thing that we hear is people's fear that we will own your home, that the bank will own your home. That's not true. A reverse mortgage is registered just like any other mortgage, so you still are on title of your home, and then we're registered just like any other mortgage. The second thing that we hear very often is that there's going to be nothing left for my kids. I have a clear title house right now, or I have a small mortgage on my house right now. And if I do this chip reverse mortgage, there's going to be nothing left. But actually, over 99% of our clients have equity in their home when they do eventually sell. Um, if we do have a no negative equity guarantee, so if for some reason our mortgage is worth more than the value of your home, you are not responsible for that mortgage amount over and above what your home sells for. But that is a super easy promise for us to make because it really almost never happens. If you have a reason not to like us at Home Equity Bank, it's probably because we're going to be so conservative in the amount that we're going to lend, and that really is just in order to protect your equity. We hear sometimes that it's expensive to arrange a reverse mortgage, and the rates are very high. In actual fact, the fees are minimal, and they are a sort of one-time fees when you initially set up your mortgage. And then in terms of rates, reverse mortgage rates are typically about a point and a half or 1.5% higher than traditional mortgage rates. And that's just slightly higher to offset the no payment feature. And then finally, you may have thought that a reverse mortgage is a solution of last resort. Um, Nothing could be further from the truth, especially in the Lower Mainland. And so it really is a tax efficient way to access the equity in one of your largest assets. So this is just to give you an idea of what happens with your equity. Because of course, we talked about how the reverse mortgage is the interest is accumulating, so the reverse mortgage is getting bigger over time, but your home is appreciating over time. So in this example here, we have a couple with a $2 million home in North Vancouver who have a $500,000 reverse mortgage. So on the day their mortgage funded, they had 1.5 million in equity. And then you can see the home value. If we assume a 4% appreciation year over year, their home value in 10 years is over 2.9 million. Now you might be wondering about that 4%. Actual home appreciation in Vancouver is higher than that. So we do use 4% to be conservative. That being said, 2026 has been a year. And so obviously housing prices are down across the Lower Mainland. But really, the nice thing about a reverse mortgage is because it's registered as a lifetime mortgage, you're not forced to sell when the market is down. So you have no payments, your mortgage is not impacting your cash flow. So you have the freedom to hold on to that mortgage for another couple of years until our market rebounds. So we have a home value in 10 years at just over 2.9 million. And the reverse mortgage balance at that time, based on current interest rates, would be just under 920,000. And so you can see that this couple's home equity 10 years from now has grown. So they have not actually lost. They have not lost it all. Their home equity has actually grown. So we talked about how you could access use the equity in your home while your home is still growing in value, and this shows that. Incidentally, Toma can do these illustrations for anyone on this call, and so you're free to book a call with him after. And I would suggest it just to sort of see what the numbers look like for you and what your equity would potentially be sort of 10, 15 years down the road. So some client stories. Um, One of the biggest uses of a chip reverse mortgage is really just replacing the mortgage that someone already has. So people are not going out and, taking hundreds of thousands of dollars and going on, lavish vacations. You're more than welcome to. But really what we see most often is people just replacing their existing mortgage with a chip reverse mortgage. So in this case, we have a client, and just so you're all aware, these are actual client scenarios, but of any identifying information has been changed, so sort of names, cities, that sort of thing. So we have our client Mark, who's 59 years old and lives in a home valued at 1.8 million. He's not retired, so a common misconception is that, a chip is a retirement mortgage. It certainly can be, but it doesn't have to be. It's really for anyone 55 or older who would benefit from no payments. So Mark is self-employed, and his business has some ups and downs in the last couple of years due to the economy. So it can be a struggle for him to manage the mortgage payments on his $450,000 existing mortgage. Sometimes those payments are no problem. Other times he's going to have to pull on, a line of credit or savings or something to make those payments. And so while he does qualify for a traditional mortgage, he did really like the payment optional feature. So he'll make interest payments when business is good, but is happy to not to for the rest of the time. So he qualified for a mortgage of $742,000. He did advance just enough to pay out the existing mortgage. So Your interest only accrues on the money you actually take. So in this case, he took $450,000. He does have access to those additional funds down the road, should he want them. But really, for Mark, this was a cash flow decision. So he went from having a $2,600 mortgage payment to a $0 mortgage payment, and that's just sort of $2,600 extra in his pocket each month. So, if this was a retired client doing the exact same thing, what that looks like is they don't need to withdraw, let's say $3,500, $4,000 a month before tax to make that mortgage payment. So they're able to, if you're retired, you're able to preserve your investments and just not make your mortgage payment. So here we have another couple, Douglas and Angela. They have a $2.2 million clear title home in North Vancouver. They are retired, they're living comfortably. They have $1 million in investments. Um, One of their kids was buying a house, and so they had agreed to gift their son $200,000 for his down payment. And they actually went to their financial advisor, and the financial advisor said, you know, hold up, stop. Um, Dr. Toma. Um, because withdrawing $200,000 from your investments, obviously, and I should mention, just to keep things equitable, they were going to gift their daughter $200,000 at the same time as an early inheritance. So rather than taking their investments down, um, from $1 million to certainly below 500,000, once you consider the tax implications, they used a chip for to be able to gift those funds. Withdrawing that amount from your investments is going to trigger a couple of things. If those investments are in a registered vehicle, you're going to pay income tax on them. And if those investments are not, if they're just sort of, in a market account, you're still going to pay capital gains on those. So there's certainly significant tax consequences to withdrawing that $400,000 from their investments. So they qualified for just over $1 million. They advanced just the $400,000 at closing to give to their kids, and zero impact to their tax status. For clients who receive old age security, withdrawing that much from your investments is going to cause your old age security benefits to be clawed back because that can look like income. And so this really comes down to tax strategy and what's the most efficient way to access their wealth. In this case, their financial advisor did say they may want to make the interest payments on the reverse mortgage. So they'll use some of their investments, withdraw them slowly to make the interest payment, just to keep the reverse mortgage at the 400,000. And so we talked about balancing, how much of your investments you use, how much of the equity from your home do you use, but that can be up to sort of a conversation with your mortgage broker, your financial planner. Very often in these situations, we hear, oh, well, I have a line of credit, I'll just use that. And if you already have a line of credit, certainly you could consider doing that. If you are retired and you don't currently have a HELOC, sorry for everyone watching, it's a home equity line of credit. So that's a line of credit that's registered on your property. If you don't already have one, those are very hard to qualify for through your bank without a significant amount of income. It doesn't matter sort of how long of a relationship you've had with your bank, in your working years, you do still need to qualify now. And most HELOCs in Canada are non-amortizing. And what that means is the balance actually isn't decreasing. So what people are doing is they are taking the remaining limit on their line of credit and using that to make the payment each month. That's just a reverse mortgage that you do yourself. So HELOC limits are not guaranteed. So even if you have a $400,000 limit today, your bank routinely reviews how much credit is extended at any given time. And so you could potentially run into a position where your limit is reduced. And HELOCs don't have that right of survivorship that we talked about. So again, if one of you should pass away, then that HELOC could potentially be called. There are situations where HELOC might work for you, and that really is the benefit of exploring a chip reverse mortgage through a mortgage broker. Toma has access to many solutions, and so he can tell you, pretty quickly whether or not a HELOC is more suitable or chip or Manulife One or a similar product. So it really is a great idea to talk things through. Here we have an example of right sizing. And for a little bit of context, we used to call it downsizing. And, downsizing would look like someone had, let's say a $1.8 million house, and they sold their house and they bought a sort of $800,000 condo, and they, banked that $1 million, and everything's great. What we see more often now, the reason we call it right sizing is, that same person that sells their $1.8 million house doesn't necessarily want to move into an $800,000 condo. Maybe they're moving into a, 1.5 or $1.6 million townhouse. And so while they may be downsizing in terms of physical space, they're not downsizing financially. So in this case, we had a client, Rebecca, living in a $2.4 million single family home in West Vancouver. She decided she was, did no longer wanted to maintain her home and her yard. And so she wrote an offer on a $1.6 million condo. Now, obviously, with a $2.4 million home, she had significant equity in that home, but how do you access that? She also didn't want to worry about putting her, writing the offer on the condo subject to sale. Just because of this market, it can take a little while to sell your existing home. She didn't want to line up moving trucks outside. And so we were able to do what's called an inter alia mortgage over both properties. So off her home in West Vancouver and over the new condo. And inter alia just means one mortgage over two properties. So essentially, we were able to, with the two properties combined, lend her $1.86 million so that she could close on the condo without drawing down any of her investments. Even if you're only drawing down your investments temporarily, that can still have significant tax consequences. So in this case, we were able to finance the full purchase price of her condo with our chip open product. So I talked a lot about lifetime mortgage and you can keep it forever. Chip open is really meant to be a short-term product for this exact situation. And so she was able to buy the condo. As soon as she moved into the condo, she listed her home for sale. And then the entire mortgage just gets paid off when she sells her existing home. And so really it means that, she was able to make this offer on the condo, did not have payments anytime, and, and could move, paint her home, paint her new home, put in new carpets, etc., sort of at her leisure. Uh, Next, we have an example of right sizing sort of the other direction. So we had a couple, John and Ann, living in a $2 million home in Vancouver. They'd been in their house for a long time, over 35 years, and the house needed a significant amount of work, had a lot of different maintenance, and neither of them wanted to do it. They really did think that they would be ready to downsize at this point, but they didn't want to leave their neighborhood. Um, and walked regularly with the other ladies in the neighborhood. They didn't want to leave their friends, their doctor, everything that they loved about their neighborhood. But again, they didn't want to take on a large renovation project. So they ended up purchasing a $3 million home just down the street, same block. So they sold their existing home for $2 million and then took a $1 million chip. Um, So this is a situation we see regularly. We do not always see people going from no mortgage to $1 million mortgage. This is just sort of a fun example that happened last year. But we do often see people going from, let's say, a $2 million home to a $2.4 million home. So maybe you can think of it on a smaller scale, um, but it really does show that the chip can be used sort of to make your life exactly how you want it, to enjoy your retirement, to have the lifestyle you want. Um, I will show you. So they were approved for 1.3 million. They advanced just the 1 million that they needed. The down payment came from the $2 million sale of their home. And so now they're in a virtually brand new $3 million home with no impact to their cash flow. So no mortgage payments. They're living just the same as they were down the street, but in a nicer, newer home. I didn't show the financial projections for all of them, but these examples, but I do think it is good to look at in this case because it's such a big number, right? So they bought a $3 million home. So on the day that they closed, they had $2 million in equity. Again, if we use that same idea that properties are going to, on average, on conservative average, increase 4% year over year in the Vancouver area. In 10 years, their home will be worth 4.4 million. Their mortgage balance will be just over 1.8 million. And so you can see that their home equity in 10 years is 2.6 million. So they were able to live, for 10 years in a beautiful home. And I use 10 years just as an average. Nothing happens at the 10-year mark where they need to leave. But this is just saying, they were 70 when they purchased this property. In 10 years, they'll be 80, and then they can, obviously stay in the home if they want, or make the decision to sell at that time. But you can see that they still have more home equity at that point than they did on the day that they purchased. Um, This is aging in place is something that we have, we've always done a lot of this type of business, but certainly since COVID, when people sort of were seeing what it was like in care homes over that time, we're seeing more and more people choose to age in place in their home. In this case, it was actually Brian and Kat. So the kids that came to see the mortgage broker, they were supporting their mom. So Brenda is 86, lived alone in her $1.6 billion home. She was in great health. Her kids, Brian and Catherine, were supporting her, and everything was great. Um, at 86, Brenda now needs more care than they can provide, but she does not want to move to a care home. Her pensions cover her living expenses uh, currently, but she doesn't have the liquid assets to support $7,500 a month in home care costs, which is what they were looking at, sort of as they were calling around and trying to find their mom the services she needed. So they really did think that their only option was to sell the home and use those funds to move their mom into an assisted living facility. What we did instead was we have a product, Income Advantage, which is a chip reverse mortgage where you get monthly draws each month deposited into your bank account. Um, so just to sort of top up your, a lot of people use it for, let's say I have $5,000 a month in pensions, but I really need $6,000 a month to live comfortably. So you can sort of draw $1,000 a month off your mortgage. In this case, they set up the reverse mortgage. Brenda did at 86 years old. We advanced $50,000 at closing to help with some modifications. They were going to sort of redo the main floor a bit to have a bed on the main floor, do some modifications to the bathroom to make it more accessible. And then they set up $7,500 a month draws to cover the costs of care. So they were approved. Brenda was approved for 880,000. We advanced to $50,000 at closing, and then they drew $7,500 a month. Um, and so Brenda's able to stay in her home. She's happy. Brian and Catherine were happy that their mom did not need to sell the home that she loved, did not need to move into a care home, and they get some relief because there's now someone there. I think it was 5 days a week, supporting their mom with what she needed. I think this is our final example. And this is the when we talk to get about balancing how you are using the investments that you have. James was 65 years old. He lives in a $1.8 million home in North Vancouver. He recently retired and did not have an employer pension. He had, really over his working years worked really hard to pay off his mortgage. And he had done that, but he had minimal investments, so about $200,000 in investments. Not a small number, but he was hoping to draw $3,000 a month from his investments to top up his CPP and OAS. And when you look at how long that $200,000 will last, withdrawing $3,000 a month, he's going to run out of money in about 6 or 7 years. So James decided instead to do an income advantage, so that monthly draw product that we just talked about, drawing $3,000 a month from his home. So he was approved for 796,000. He did not take a lump sum at closing. He merely, you know, advanced that $3,000 a month into his bank account. And when we look at what his situation looks like, in this case, I projected it out 15 years. So when James is 80, assuming that his home again appreciates at 4% each year and that his investments grow by 5%, when he's 80 years old, he'll have $2.2 million in home equity. So he went from $1.8 million in home equity on the day that his mortgage funded. 15 years later, that's $2.2 million. But we also have those investments. He had the $200,000 investments that he did not touch for those. Well, at 71, you are required to do minor withdrawals, but his investments are now worth over $415,000. So his net worth went from $1.8 million to $2.6 million. And he, for 15 years, received $3,000 in his bank account every single month. And so that's really the power of using the equity that you've built up over all these years to fund the life that you want in retirement. Yeah,
That brings the presentation to a close. Thank you very much, Jen.
you're
I
welcome.
see there's only a couple of questions here, so we'll field those. And then I'll just close off with a couple of comments and we'll go about our merry way this evening. Jen, the first question I see here is the obvious. You touched on it. What are the rates for reverse mortgages? Give us a range. And then when you said the setup fees are one time, how much does it cost to set up a reverse mortgage?
Yeah, for sure, for sure. Currently, we have a special, and we have a 3-year rate special at 6.19%. And then in terms, we do also have other terms, but we're finding that 3 year is really attractive for most people. So most people are taking that 3-year 6.19. And then in terms of costs to set up the mortgage, you have three primary costs. So you have the cost of an appraisal. So typically that's about $350 in the Lower Mainland. And that's sort of your one out-of-pocket expense. You're going to have independent legal advice. So every reverse mortgage in Canada, you are required to have independent legal advice from a lawyer, and typically that's about $800. And that 800 can be taken from your mortgage proceeds, so you don't need to worry about, coming up with that upfront. And then finally, there's the setup fee of $1,795, and that covers a few things. It covers the legal lender legals. It covers title insurance, sort of a few sort of behind the scene costs. But that's a one time cost that also can be taken from the mortgage amount as well.
Thank you. I will just touch on that, Jen, before we go on to the next question.
Yeah.
Guys, mortgage rates in reverse mortgage land are generally at this time in the 6% range, whereas you see sort of traditional bank mortgage rates in the high threes to low fours right now. So that's the spread. And as Jen sort of touched on, the reason for that sort of premium is just the risk involved in not having any form of repayment over the life of that mortgage. Because the intent here is to be in the mortgage for the long term, and we have a lender who's not getting any form of cash flow out of that mortgage. So that kind of, I guess, justifies the higher rate. And then in terms of setting up this mortgage, the one thing that Jen touched on is independent legal advice. There's an important distinction I think a lot of people don't realize when they get a traditional bank mortgage. Part of the process near the end, of course, is when the mortgage gets finally signed off and we send it off to your notary or lawyer. I don't think many people realize this, but when you're sitting in front of your notary or your lawyer, technically that person is not acting for you. All they're doing is witnessing your signature. They're not providing you with legal advice. They are acting for the bank. So what's been inserted as a sort of a consumer protection measure, specifically with reverse mortgages in Canada, is independent legal advice, which is to say you go to your lawyer and your lawyer acts on your behalf, looks at the paperwork generated by the lender's lawyer and says, here's the pitfalls and here's the pluses and minuses that I may not have already touched on. But the fact of the matter is there's that extra layer of protection for this type of consumer. The only other question I've got is when technically does the mortgage have to get paid off? Like at what specific point does that actually have to finally get paid?
Yeah. So in order to not sort of default, I guess, on a reverse mortgage, you do need to live in the property for at least 6 months of the year. So it does need to be your primary residence. We do follow snowbird rules. So if you go down south for 6 months of the year, that's fine, as long as it's your primary residence for 6 months and a day. So if ever the property was not your primary residence, the mortgage would become due at that point. Um, Other than that, the mortgage can go for until the last surviving homeowner passes away. So if, for instance, we lent to a husband and a wife, and the wife passes away after 15 years, and the husband, passes away sort of 18 years in, um, once the husband passes away, you have 6 months to pay us out. The estate would at that point. And that's a really normal process. It's the same process that, if you had a traditional mortgage on your home and someone passed away, the estate pays out that mortgage. It's the exact same with the reverse mortgage.
Got it.
When the last remaining homeowner, should they move into a care home, at that point, obviously we know the family's going through a lot at that point. So you have a year to pay off the mortgage.
Got it. Just some other thoughts that come to mind here. These mortgages are offered on these terms and conditions, and I guess the other things that should be touched on is that in order to maintain the mortgage in good standing, there's three basic things that are asked of you. There are other terms and conditions that I and a lawyer will go through with you, but the three basics are number one, you've got to maintain the home in a reasonable state of repair. Number two, you've got to pay your property taxes every year, whether you pay them actually or whether you defer them. That's sort of part of your financial plan. And number three, you've got to maintain home insurance in good standing as well. As long as those three key pillars are taken care of, then the mortgage is considered to be in good standing.
Yeah. Yeah, and thanks for
So,
mentioning, just quickly, you mentioned deferred taxes. So yeah, you are welcome to defer your property taxes with a reverse mortgage. If you do currently defer your property taxes, this is the exact same idea. You're just deferring your mortgage payment. It's really no different than deferring your property taxes.
so we've got a very captive audience that has no other questions. I'm just going to close off here by saying reverse mortgages, like I say, when you say the word reverse mortgage to many people, a lot of them and dismiss them and sort of rattle off any of those sort of myths that we've attempted to dispel tonight. And like I said, they're not necessarily a tool of last resort. They are used in those instances, but very rarely. I think it's going to become increasingly apparent to the Canadian public that this is a viable financial tool that should be used intentionally to complement your existing financial plan. I'm starting to work with a lot more with these products, a lot more with investment advisors and portfolio managers and accountants when these folks come to realize the tax effectiveness of some of the scenarios that we've shared with you, and also the ability to preserve capital that's outside of the primary residence. So, triggering capital gains or triggering income or messing up your pension can all sort of be neutralized in a carefully laid out plan in conjunction with your other financial advisors. So I'm starting to become more of a team player with this type of product, where it's being used as a much more deliberate and sophisticated tool than what I think a lot of people think it to be. So that being said, is there any other questions? I don't think so. I don't see any more. I want to thank you guys for taking the time. We're coming up against that magic 45-minute window, right to the point. So without further ado, thank you all for attending tonight. I really appreciate you coming out on a sunny summer evening. If you have any other questions, of course, you can just hold up your phone there to the QR code, but obviously many of you have my phone number. If not, if you want to talk about this a little bit more, just go to book.tsmortgage.ca, set up a call, and we'll talk about it more. But for now, that's it. Thanks very much, everybody. Have a good evening, and we'll talk again soon.
Thanks, everyone.